Hi, everybody. It's Brendon Jenks here, the investor coach in Kansas City. And I was recently asked by a client a question that almost stumped me in terms of being able to give a simple answer. I wanted to talk about that today. The simple question was, what makes the market go down? And I had a hard time answering this in a simple way until I actually listened again to an interview with a guy named Eugene Fama. And interestingly, Eugene won the Nobel Laureate Prize in Economics in 2013. And so, of course, leave it to an academic to make a complex subject very simple. This is actually a picture of me with Eugene that same year. That's David Booth on one side, and Eugene is the academic one right here. So anyway, Dr. Fama, he boiled the complexity of why markets go down to two simple concepts and statements. That was profitability and people. So let me explain. Profitability for companies is down relative to the past. Now, when we buy stock in a company, what we're doing in effect is exchanging our money for the opportunity to share in the profit of that company. So they share those profits in two different ways: through dividends, which are declared by the company, or share price increases determined by the market. And it could also come as a combination of both to you and me as the investor. Well, relative to the past, profitability is down. On top of that, many investors are also risk averse. And that's where the second concept of people comes into play. So if people are more risk averse, the demand for stocks is going to be down as well. So all of these factors impact the price of that individual stock. They also impact the price of the market as a whole. So the one thing that we know about all this too is that in an efficient market, these things are random and unpredictable. So our tendency to want to time the market or to figure out or understand when to get in and out is really a loser's game. So the adage that comes to mind when I think of that is timing the market is not a good thing to do, rather than time in the market. So in closing, if I were asked for a simple formula to help investors increase their level of peace of mind with investing, it'd be this one behind me right here. C is the cognitive side. That is the brain. We have simple rules of investing to follow. The other side of this equation relates to the emotional, instinctual, perceptive side of us. So my job, my role as your coach is to make sure that C remains greater than the other side. So we can't let our instincts, our emotions, our perceptions, magnified by the media, interfere with the simple rules and the strategies that we know work. Thanks for watching. I'm Brendon Jenks, the investor coach, where education and coaching is the key to investing peace of mind.